Want to own a piece of one of the world's most successful and best known businesses? Like the idea of beating the market on yield and beating inflation on growth? Does getting a great deal on a great stock after it's fallen by nearly 40% sound good to you? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before we get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a global coffee giant providing people with a low-cost, attainable luxury. Most companies try to get a product or an experience right because getting either one right can lead to making a lot of money. Well, this company has been able to master both. As you might imagine, that has led to rarefied levels of success. And this success continues to translate into the business being able to increase its revenue, profit, and dividend at high levels like clockwork. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of SBUX Corporation, which appear to be trading at a significant discount today. SBUX Corporation, stock ticker SBUX, is the world's leading retailer of high-quality specialty coffee products. These products are sold in 34,000 stores across 80 different markets in addition to multi-channel retail. Founded in 1971, Starbucks is now a $90 billion by market cap global coffee titan that employs nearly 400,000 people. Company-owned stores accounted for approximately 84% of fiscal year 2021 revenue, while licensed stores accounted for approximately 10% of fiscal year 2021 revenue. Other sales made up the remainder. The company splits its revenue across two primary geographical segments: North America, 70% of fiscal year 2021 revenue, and international, 24%. Channel development, or retail CPG, as well as corporate and other, accounted for the remainder of revenue. The US is by far the company's largest single market, comprising 45% of the global store count. China is their most important international market, comprising 16% of the company's total global store count. This venerable company has one of the world's best known and most respected brands. How did they build this? I think it comes down to the fact that they're selling a cheap, simple luxury that anyone can attain, and they're doing this by way of both a product and an experience all wrapped up into one. Sure, you could make a cheap cup of coffee at home, but Starbucks offers a higher level drink attached to an elevated socialized experience within their lounges, and consumers are all too happy to take them up on the offer. As someone who is personally in a coffee shop almost every day creating content and managing investments, I can attest to the appeal of this product experience combination. See, a lot of companies try to nail either a great product or a great experience. Starbucks, on the other hand, has been able to nail both. While the pandemic did negatively impact the experience side of what Starbucks offers by way of shutting down the lounges, this was temporary. Moreover, Starbucks may have benefited permanently more than it suffered temporarily. That's because many small independent coffee shops lack the financial wherewithal necessary to survive the pandemic. Starbucks was already a world-class enterprise heading into the pandemic, with its leading market share built on global acclaim and recognition. It could end up even more dominant on the other side, as competition has been almost certainly reduced. This sets them up to slingshot to greater heights than ever, growing their revenue, profit, and dividend for years to come. As it stands, Starbucks has increased its dividend for 12 consecutive years. The 10-year dividend growth rate of 20.7% shows what a strong start they're off to. That said, I do see the more recent dividend increases, which have been in the high single-digit range, as more indicative of their long-term dividend growth capacity. The stock's market-beating 2.5% yield even offers a respectable income story. By the way, that's 60 basis points higher than the stock's own 5-year average yield. And with the payout ratio sitting at 52.4%, the dividend is comfortably covered. You're slaying two dragons here. The yield beats the market, and the dividend growth rate beats inflation. I always like dividend growth stocks in what I refer to as the sweet spot, a yield of between 2.5% and 3.5% paired with a high single-digit or better dividend growth rate. The yield is admittedly on the low end of that range, but the high growth rate more than makes up for it. Great dividend metrics here. Looking at business growth, Starbucks increased its revenue from $13.3 billion in fiscal year 2012 to $29.1 billion in fiscal year 2021. That's a compound annual growth rate of 9.1%. Impressive. I'm usually looking for mid-single-digit top-line growth from a mature business like this, but Starbucks obviously did much better than that. Earnings per share grew from 90 cents to $3.54 over this 10-year period, which is a compound annual growth rate of 16.4%. Again, just super impressive stuff here. We can now see how the business has been able to afford handing out double-digit dividend raises over the last decade. The underlying business has been growing in kind. A combination of margin expansion and share buybacks helped to drive this excess bottom-line growth. Regarding the latter point, the outstanding share count has been reduced by 23% over the last decade. Looking forward, CFRA anticipates that Starbucks will compound its earnings per share at an annual rate of 13% over the next 3 years. This growth forecast isn't that far off from what Starbucks demonstrated over the last decade. I see two sides to the growth coin here. On one hand, Starbucks is a revered brand that commands a large amount of mind share and market share. I suspect that Starbucks has taken and will continue to take even more market share by virtue of less competition in a post-pandemic world. In addition, Starbucks is keeping its foot on the gas pedal by expanding its global footprint. The company is expected to open approximately 2,000 new stores this fiscal year, most of which will be across international markets. At the same time, they're posting up terrific comps, up 7% globally year over year for Q2 fiscal year 2022, even after factoring in China lockdowns. On the other hand, it's that last point that brings me to the other side of the coin, and it really is the elephant in the room. The pandemic-related lockdowns in China will weigh on the business. However, the dark side of the coin is a short-term problem. The other side of the coin offers up long-term solutions. In my view, it'd be silly to expect a significant slowdown from Starbucks relative to their performance over the last decade. If anything, it is possible that the next decade is even better. It begs the question, if the company did what they did with a smaller footprint and a global pandemic, what might they do with a larger footprint and no global pandemic? Using CFRA's earnings per share growth forecast as our base case, Starbucks is primed for at least high single-digit dividend growth over the foreseeable future. I think that would be a splendid outcome when also considering the 2.5% starting yield. Moving over to the balance sheet, the company has a very good financial position. Negative shareholders' equity means there is no long-term debt-to-equity ratio here, but an interest coverage ratio of over 12 shows us that the company is having no difficulties with servicing its debt. To add further context, their $13.6 billion in long-term debt is relatively small in relation to the company's $90 billion market cap. Profitability is robust. Over the last 5 years, the firm has averaged annual net margin of 12.4%. Return on equity is not applicable because of negative equity. Starbucks is running a world-class enterprise that is getting bigger and arguably better. Whether the consumer wants to spend more on products or experiences, Starbucks is poised to benefit. And brand value, pricing power, economies of scale, a global distribution network, and a competent omni-channel strategy are durable competitive advantages that defend the business. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. While I see regulation and litigation as somewhat limited risks compared to many other industries, the QSR space is notoriously competitive. Input costs are volatile and rising, especially in terms of labor. Adding further pressure and uncertainty in their labor story is a growing unionization drive across their stores. Being a global company, they're exposed to macroeconomic issues and broad economic slowdowns. The pandemic and its shutdowns, especially in China, are emblematic of this. Perhaps the biggest risk to long-term growth in relative terms is the law of large numbers. Their massive size could start to work against them in the near future. It's important to carefully think over these risks, but I do see the quality and valuation of the business as overcoming these risks. With the stock down nearly 40% from its 52-week high, the valuation looks very compelling right now. The stock is trading hands for a price-earnings ratio of 21.1. That's not terribly low in absolute terms, but it is a lot lower than its own 5-year average of 47.4. Now, this comparison is difficult to make. Starbucks has often printed lumpy GAAP results, but if we go straight to cash flow, the price-to-cash flow ratio of 17.5 is well off of its own 5-year average of 27.4. And the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. This 8% mark is as high as I'll go, but I believe that Starbucks is worthy. I see nothing to indicate that they can't clear this hurdle. The company has clearly proven itself as capable of producing double-digit earnings per share and dividend growth over the long term, and it appears that the near term is full of the same. While the company could do quite a bit better than my number over the medium term, I also think we should expect a moderation in dividend growth when looking out beyond 5 or so years. Averaging things out though, I'm comfortable with this model. The dividend discount model analysis gives me a fair value of $105.84. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts the future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Starbucks as a 4-star stock with a fair value estimate of $100. CFRA rates Starbucks as a 3-star hold with a 12-month target price of $80. I came out very close to where Morningstar is at. Averaging the three numbers out gives us a final valuation of $95.28, which would indicate the stock is possibly 21% undervalued. Here's the bottom line, guys. Starbucks Corporation is a world-class institution that is becoming bigger than ever, and a clear case could be made that it's also becoming better than ever. It has the rare distinction of mastering both a product and an experience for consumers all over the world. With a market-beating yield, double-digit dividend growth, a moderate payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 21% undervalued, this is a fantastic investment idea for long-term dividend growth investors to strongly consider. And now for a special news announcement. Comcast Corporation, stock ticker CMCSA, just scored a big win. Their new movie, Minions: The Rise of Gru, set an Independence Day weekend record with $125.2 million in domestic gross ticket sales during the 4 days. We just put out a video highlighting how the cord-cutting thing is vastly overblown and how Comcast is so much more than just cable TV. This box office win underscores that point. As our video points out, this high-quality dividend growth stock looks severely undervalued. Don't forget about it. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.